Good morning, everyone. Thank you very much for joining us at this cover webinar. I'm really excited to have with us two experts in the environment of behavioral finance and emotional intelligence. We've got Mark Baker, the CEO of Mygrow. He's an emotional intelligence expert. And then we've also got Paul Nixon, behavioral finance specialist. So really great to have you guys here. The idea today is Paul, myself, and Mark are just going to go through a bit of a discussion around the concept of behavioral finance and emotional intelligence and how the two link up each other. And then afterwards, we're going to open up for a couple of questions and so on. So during the time, you're welcome to put your Q&As into the queue and prepare for a bit of interaction at the end of the day. So maybe Mark, starting with you, if you can just give us a quick intro as to how did you get to be an emotional intelligence expert?
Well, hi everyone. Great to be here, Tony. Hi, Paul. I think my journey was a very personal one, Tony. I qualified as a psychologist, not realizing I was just on my own journey to figuring myself out. And after working for about a decade in leadership development, just realized that there was this regression curve that I kept seeing in my life and other people's lives of great excitement for change when stumbling across this world and this domain of emotional intelligence or any kind of personal development, actually. And then between the start and the end of a particular course or process or leadership development program, there would be this spike in desire to change. And then a few months later, a regression back to habitual and reflex behaviors, back to the norm, back to the mean, if you like. And it sent me on a journey of just trying to uncover what is some of the neuroscience behind behavioral change, and with technology and what it can do through things like micro learning and habit prompting and behavioral implementation. It led to some of the work I've been doing over the last 10 years, which is focused on how technology can facilitate the development of emotional intelligence competencies. And so that's the work I'm involved in currently through Mygrow. It's tech-enabled EQ development. So my interest in this conversation is really just, how the domain of self-management and interpersonal management, the domain of emotional intelligence, can really play into some of the financial advisors and their personal experience of the work that they're doing, and then also the experience of some of the people that they're working with, which is obviously Paul's domain. Thanks, Tony.
Great, thanks, Mark. And Paul, your journey here.
Good morning, everyone. Thanks very much for having me, Tony, and good morning, Mark. So I started a long time ago, as you can all probably see from the frown lines. In neuromarketing in about 2000, I published some research on the link between the sense of smell, so that's through olfactory sense, and then behavior, basically. So as it turns out, our olfactory sense plugs directly into our sense of smell plugs directly into our limbic system, which is our sense for fear and risk. And at the time, there was a German company that was looking for some research to start selling these big industrial machines to pump different smells into casinos to elicit sort of different behaviors. So that was a very interesting part to my sort of foray into behavioral science. I then joined the financial services sector. Actually, also a funny story. A gentleman told me I was in marketing at that stage, and a gentleman told me I was going to be the marketing director of this franchise, and it was a guy from Liberty. And I got to work the first day, and there was a telephone book. So you probably don't even know what that is, but one of the big telephone books you could use as a doorstop, and a phone. So I was actually there to sell insurance, but yeah, so he sold the job to me as being the marketing director of this franchise, and that's how I started in financial services, and I never left. so from there, I actually became a financial advisor and wealth manager for a number of years. And then actually when ABSA and Barclays had the marriage, I joined that team in Johannesburg and then got a chance to work in London with a really fantastic PhD in behavioural science, Greg Davies, who has now got his own firm called Oxford Risk. And I mean, he had an absolutely wonderful team of people around him, all PhDs. And we had Professor Robert Schiller, who used to join our sort of Monday calls, obviously a Nobel Prize winner in behavioural economics, and obviously a number of papers that he's written as well. And that's what really started my sort of, almost the journey back into behavioural finance. And Greg had developed a financial personality assessment, which he developed for Barclays, which he actually took when he left Barclays to Oxford Risk. And that really sort of prompted the interest to figuring out how I could get back into behavioural science and finance, but in a financial decision-making context. And when I joined Momentum a few years later, actually, I then sort of had to get into machine learning almost, because out of necessity, right? So if you want to try and scale a behavioral finance function without sort of getting a number of people to work for you, you can actually use machine learning to do that for you. So but it's sort of almost prompted out of necessity to look at large data sets and to try and figure out what people were doing, and also figure out what their advisors are doing as well, and try and sort of develop different behavioral tracks to try and change that behavior. And obviously using the technology side, but also psychology and the financial personality side as well. So that's how I find myself here today.
Brilliant, fascinating journey. Yeah, I mean, me having been in this industry for a long time, I know I often complain about the fact that every year the industry launches reports on retirement, etc. And since I joined in the early 90s, it's always been only 94% of people can retire comfortably. We haven't changed a thing about that. And I think the crux of that matter is behavioral finance, nothing else. We saw that now with the two-pot system and all the withdrawals, that people wouldn't have thought about withdrawing money from their pension fund. But when that two-pot system hit, everybody thought, "Ooh, what can I do with this money?" And that's the challenge that we're sitting with. And then from an investment perspective, we've always had this problem. I know, again, when the old story, when markets suddenly start rising, everybody wants to buy. And when markets start dropping, then everybody wants to sell. And it's exactly the wrong time to do both, but yet this is a recurring theme. But just on that note, they always say that you have to start with an icebreaker. You mentioned the casino thing, and I thought to myself earlier on, we spoke about when we were prepping for this, we spoke about how do we monetize this whole environment, etc. And the first thing that came to mind for me was, well, with Mark, it's quite easy for me to monetize it, because I'll just invite him to a game of high stakes poker, because his emotional intelligence is so high that he's got everything on the table, can see right through it. And then, Paul, when it comes to you, I think to stay right by your side, because as they say, you can probably spot a market overreaction before the herd panics. And and if I am next to you at the time when you spot it, we can both benefit, and afterwards we can use Mark to help us rebalance our emotions. So I think there's some good value out of this. So now let's start unpacking this a little bit. I think that maybe we start with Mark, just to ask, I mean, we've read a lot about emotional intelligence. There's been loads of books. Everybody gets these things on Facebook and everywhere to test your emotional intelligence and all sorts of things like that. But what is it really, and why does it actually matter in this context?
Thanks, Tony. Yeah, something I've been very interested by in getting immersed in the field of emotional intelligence is actually how thin many people's understanding of it is. And I think that's even true of me. I was a qualified psychologist doing training in this domain, the domain of human behavior, psychosocial functioning, and I had a very thin understanding of what emotional intelligence is. I think what makes it somewhat more complex is that the understanding of it is typically driven by the models that are created to try and describe it. And so many people will be aware of, for example, Daniel Goleman's book, The Emotional Intelligence: Why It Matters More Than IQ. That was in 1995. Can you believe that? That's, if my maths is up to anything today, that's 30 years ago that this domain was brought into the kind of public sphere as a construct. And something that's been quite misunderstood since then is that it is in fact not one thing. It is a conglomerate of things. In fact, we should talk about it as emotional intelligences. In the work that I do, I like to describe it as a set of competencies that I would liken to muscles. That, just like in our body, we have different muscles that allow different types of functions. In the same way, the domain of emotional intelligence has different competencies that allow us to function for better or worse in different circumstances. And so at its core, it's about two things. It is about managing self, and it is about the second thing is interacting with others. And on the spectrum of both of those, there is a conglomerate of competencies that allow us to manage the way we interact with the world from the inside out, and then also the way that we interact with others from the outside in. And so it really leads to probably at least 5 different kind of domains within the sphere of EQ. The way we perceive ourselves would be one of them. Do I have value? Is there meaning and purpose in my life? Am I aware of this guy over here? Okay, that might be the domain of self-perception. Early writings in the field of psychology started to unpack something called self-esteem. That would be in that kind of domain. Another one is self-expression, the way I live out myself within the world. And that would involve competencies like, how I'm able to assert myself or not. Am I able to express certain emotions or not? You were sharing about, sitting next to me at a poker table compared to Paul. I certainly think Paul would have a better poker face than I would. And so that way of expressing ourselves impacts on the world. And then there's an interpersonal domain. How do I navigate and manage relationships? There is a decision-making domain. Very interesting in this discussion, Paul, I'm sure you've seen it in so much of your research, how emotional decision-making actually is, and particularly in relation to finance. And I think that might be something we'll touch on in this discussion. And then, of course, the management of stress. How do I manage the dynamics of the world around me? So this is the field of emotional intelligence. And one quick thing to say, Tony, is that the neuroscience of emotional intelligence maps very interestingly on physical fitness as a metaphor. That these competencies can be thought of like different muscles in the body. And the research is quite clear that it is possible to shift the competency levels on these domains by implementing techniques. A little bit like, strength of a muscle can be shifted significantly by implementing exercises over time. And that's part of the work that I'm certainly applying myself to currently.
Yeah, excellent. And Paul, on your side, I mean, behavioral finance, it obviously links behavior to how we interact with money. But how do you define the scope of that?
Yeah, Tony, so a good question. I would say that, behavioral finance has probably gone through, a series of growth phases or metamorphisms, or what do you call it, a number of things. I think it sort of started out with this this obsession with diagnosing, biases, for example. So to look at the, obviously in finance or financial market theory, we have the market has a fair value in respect of, what companies are valued at as a present value of the company's expected future cash flows. And then obviously if there's the market price or the share price was different to that value, which is the fundamental value, then obviously we could sort of probably debate a number of reasons as to why that is, right? So our market's overreact or underreacting to certain news events, for example. And that sort of progressed a little bit towards the individual, but again, the focus was on biases. And I mean, I think on Wikipedia at the moment, there are over 200 listed cognitive and emotional biases. The problem really with that is, that doesn't really help anyone, right? So if you're diagnosed with something, and definitely if you have, even if you actually look at trying to change your emotional reaction to something, it doesn't really work, because your emotional reactions are designed for you not to be able to manage them, right? I mean, that's what's kept us or gotten us to this point in our evolution. So, my statement is a really great researcher in California. He for the CFA Society, and he came up with the second generation of behavioral finance, which I think is getting things to a far more practical level, right? So how do we, instead of looking at the, there was a really bad sort of, Spock versus Homer Simpson analogy. And it was bad, not, I mean, that's how it started, right? But it's bad for Star Trek fans, because the interesting thing about Spock is probably the epitome of the struggle that all human beings are faced with, right? So he's got this human side, which is the emotional side, and then he's got this sort of Vulcan hyperlogical side. So actually Spock is, you don't really need to go further than that, right? Spock is actually the perfect metaphor for the human struggle against emotion. But what my statement, coming back to what his research or what his proposition of looking at behavioral finance, which he calls the second generation of behavioral finance, is that people are normal human beings. So we all have that struggle within us. So it actually doesn't really help to diagnose people with a list of biases. What actually helps more is to try and first of all understand what the underlying motivations are behind that behavior, and then helping people to sort of manage their own journey through that. So for example, we need to realize that human beings have expressive needs, right? So we like to communicate with each other by stuff that we buy. So for example, if you look at expressive needs versus utilitarian needs, so if you look at a watch as a good example. So a Tag Heuer watch or a Patek Philippe watch tells the time. That's the utilitarian benefit. But if you're going to pay $2.5 million for a Patek Philippe watch, it better do more than tell the time, right? Because it's telling other people things about you. So it tells them things perhaps about your status. It tells them about your desire for quality. A number of things. So we all have these expressive benefits. There's no point in trying to kind of squash those. Let's rather, from an investment point of view, play into that, right? So if you want to, if you believe, for example, that the world of the monetary system is progressing in a certain way, you might get a big benefit of when you're around the braai telling people about Bitcoin, right? And kind of how you're picking, or you've managed to pick the way the world is going. It's not really helpful to try and sort of squash that. It's from a portfolio management or portfolio theory perspective, it's better to build portfolios that incorporate those benefits into the portfolio. So rather than tell people, for example, that Bitcoin is whatever your view is, pro or con, rather teach people to build that expressive need into a portfolio, but do it in a responsible way. So rather, let's say 5 to 10% of your portfolio should be in a private equity, hedge fund, Bitcoin, crypto, whatever the case may be, right? So because people like to talk and brag about stuff. So that's a benefit they get from this. So when they're around the braai, they will, especially now that Bitcoin, I think again is touching on all-time highs, they will probably tell people that they've invested in this, and that's part of the benefit they get. So, I think again, just to sort of give the transition again, we've talked about outcomes-based investing, for example, and outcomes-based investing to a large degree has failed. And it simply failed because it doesn't necessarily incorporate a lot of these utilitarian or rather expressive benefits that people actually get from their investment portfolio. So I think to kind of wrap up, behavioral finance, I think, is migrated to the point where there's more of an understanding of, let's try and understand who the person is behind the financial decision. And let's try and get a better understanding of what those persons' expressive benefits are, their emotional benefits. Do they like ESG? Do they have certain preferences in respect of where they invest their money? in addition to the utilitarian benefits of outcomes-based investing, for example, so that we can actually build a portfolio that people are more than likely going to stick with, right? So they identify with it. It's aligned with their value system, for example. It's aligned with certain personality traits that they might have, for example. And that is far more likely in that way to get that person to stick with a strategy than to just tell them, look, outcomes-based investing, asset allocation is 90% of the game anyway, so just buy this and stick with it. That might be true, but people still don't do it. And if people don't stick with it, then there's actually no point in kind of this outcomes-based approach, right? You have to design stuff that is going to appeal and connect with the person behind that portfolio. That's going to make them a lot more likely to stick with it. So I think that's the important migration of behavioral finance, is in trying to build portfolios that actually people actually stay invested in, because they identify with those portfolios.
Okay. Yeah, I'd like to touch on that again a little bit later. Thanks, Paul. So, I mean, to sort of try and get a bit practical here, let's take an example of somebody panic selling in a market downturn, which is a common thing that happens. So if we look at that, and maybe starting with you, Paul, what's really happening beneath the surface for that person in terms of their behavioral sort of lens? And then from Mark's perspective, how could emotional intelligence then help that person to pause and make a better decision? So starting with you, Paul.
Thanks, Tony. Yeah, so a number of things are probably happening, right? But and this is really where machine learning is quite useful, because it can give us a very good idea. If we analyze a massive set of data, for example, we can identify certain patterns that people are predisposed to. But of course, the drawback of machine learning is that it also memorizes noise as well as signal. So we kind of use a large set of data to try and get that out of the minimize the noise. But there is always going to be noise in that data. Where we can start to get a little bit closer or minimize the noise even further is if we start to have a look at people's underlying factory settings, right? Or their personality, for example. So and this really, that's a deep subject, right? So I mean, Mark can probably talk for a day on that. But if we look at it at a surface level, certainly at the level which I look at it is at a very, if we can call it the high level, which is the big 5 personality trait level, right? So we look in respect of published literature, for example, in financial behavior, there are 2 personality traits that are quite predictive of people's behavior in terms of their financial decision making, and it's been shown in a number of papers, but not just financial decision making, actually across the board. So we look at 2 personality traits being conscientiousness. So that basically determines the individual's sort of proclivity or kind of natural inclination towards delayed gratification. So simply put, is that person if you gave them the marshmallow test, would they end up waiting for the second marshmallow, right? And by the way, I mean, the marshmallow test is an interesting example, because if you look at the fact that was done on kids, and if you actually go and watch the marshmallow experiments again, it's actually fascinating. You can see at a very, very early stage in people's lives, kids between the age of 4.5 and 6.5, that some of them are just better at the future than others. So you can see that, and by the way, it's not easy, right? So even the kids who are good at it, I mean, you can almost visibly see the kind of pain that they go through just in terms of waiting a couple of minutes for an extra marshmallow, right? But when you're that age, sort of a couple of 10 minutes can seem like a lifetime. But you can definitely see that some kids almost are predisposed to developing those techniques on the fly to think about the second marshmallow. So some of the kids, for example, would cover it. Some of them would stare into the corner of the room. Some would sort of, almost turn away from the marshmallow, start humming. So techniques to distract themselves from that second marshmallow, right? Other kids, before the instructor even actually has gotten halfway through explaining how the game works, the marshmallow is in the mouth already, right? So there's definitely that some of us are just better at it than the other. It's important to mention as well at this stage that there's no good or bad personality traits, right? I mean, we've talked about neuroticism being possibly one of them, but in general, people, like the friends that you have with the best life experiences are the ones who are impulsive, right? So it's those people who at 2 o'clock in the morning, 1 o'clock or 12 o'clock at night decide to, like, we're going to go here, or we're just going to do that, or we're going to book a trip overseas. We're not going to Airbnb. We're only going to book the accommodation when we get there, right? Those kind of people have great life experiences, but they don't have such good in general financial experiences, right? Because that predisposition, puts pressure on the income statement to kind of spend now. So if you look at conscientiousness, that's definitely one of them we can look at. And then neuroticism is the other one, which is your general level of anxiety, right? So some people just worry a little bit more about stuff than others. And if you look at that sort of, Tony, just to give an example, I mean, Momentum Corporate actually just released a really, really good bit of research using our psychometric profiler. We could actually predict pretty accurately about 65% of the occasion, just understanding people's personality traits and their underlying money attitudes, which are linked to those in respect to their two-part withdrawals. So about 65% of the time, we could pretty much predict whether that person was going to dip into the two-part or not. And as you've already mentioned, Tony, I mean, the interesting thing about that as well is we've seen that, in terms of our, actually across the industry, the people, if you look at the tax rates that people are paying on two-part withdrawals, they're not low, they're high, which means that the intention of the system is not really working, because the people who are dipping into the two parts actually are people who are doing, and you would see it from sort of financial advice or feedback from financial advisors as well, people to do home renovations or, stuff like that. So, I think sort of wrapping up with answering your question, we can use technology to kind of look at what patterns of behavior people tend to fall into, but then we can also look at psychology or personality science rather, to at a very, very high level. And that's the really wonderful thing about this. We don't actually have to go deep, right? We don't need an Enneagram in a person to 120 questions to figure out if they're going to do this stuff. We can actually just look at the big five, or actually two of the big five personality traits, and get a fairly good indication of whether someone is going to make an impulsive decision, or whether they're going to panic sell, or so panic selling would sort of fall more into the neuroticism or anxiety kind of dimension, and then conscientiousness would be the kind of delayed gratification, or withdraw two-part early kind of financial behavior. So the really, really fascinating thing about this is, and we were talking before this webinar started, I'm flabbergasted that it's taken this long. Just on knowing very, very high order personality traits, you can get a very, very good indication of what someone's likely to do. And that for me is a very interesting part of sort of how you sort of join or merge these two fields.
Absolutely. And I think that's where Mark comes in with Mygrow, and how you try and help people to change that behavior. But just on the question that we asked and what Paul said now, how could emotional intelligence help people to pause and make a better decision?
Yeah, I think, Paul, I absolutely love the personality science that you're bringing in, with especially these two from the big five, conscientiousness and neuroticism. And I think what the beauty of the big five is, it's just so intuitive. Those of you that are not familiar with personality profiling, big five is essentially taking 5 of the core constructs that are found across many different personality assessments. You may have heard of Enneagram or Myers-Briggs or whatever it is, Discovery Insights. These are all trying to just plot people into behavioral tendencies. And something maybe that I could add, Tony and Paul, to what you've shared, is that, in this kind of research, typically what is being assessed is correlation. There's a correlation between conscientiousness and or neuroticism and a particular type of buying behavior. I think, Tony, where I would come into the discussion is in terms of causation. What is in fact causing certain behaviors to be made? And, a couple of things that come to mind is, underneath this layer of personality, which typically tends to describe behavioral tendencies. And Paul, you've mentioned it a number of times. I actually wrote down one thing you said here. You said some of us are just better at it than others, which is a very personality kind of aligned paradigm, that people are born with certain traits, that they will tend to behave in this kind of way. Even conscientiousness and neuroticism, you were talking about the marshmallow experiment, there'd be correlation there in terms of impulse control, which is of course what that experiment was trying to assess. And in the domain of emotional intelligence, what I find to be the beauty of it is it really is looking at the way neural pathways have been created and established in the narrative of one's life and what that has caused in terms of reflex responses to the world. And so instead of bringing the lens of certain inherent personality traits, Paul, to that marshmallow experiment, and the extrapolation is to behavioral finance, I think what I would bring is the internal narrative of a life journey that those kids would have lived under certain parents in certain dynamics of their life, where they've been offered, you know, were they the older child or the younger child? Well, if there's 2 marshmallows, you better hurry up and gobble up one, because you're not in fact going to get 2 later on, which then speaks not so much to personality traits such as conscientiousness. It may speak to deeper lying reflex responses like the fight, flight, freeze, or appease response. And these have been shown to be quite variable for adults with the implementation of certain techniques that can start rewiring some of those behavioral pathways. So to bring that, you know, to take that from the marshmallow experiment through, I'd love to share another experiment here and then bring it to behavioral finance. But what we see in the domain of emotional intelligence is where, you know, where the ability to manage one's reflex responses to a particular dynamic have been suboptimal, let's say, leading to, for example, a lack of impulse control before. It is possible with certain techniques to, in fact, increase the ability for impulse control, particularly by going on a journey to understand some of the narratives that would lead to that. For example, in the marshmallow experiment, that I'm not going to get any unless I gobble up one now, you know, because when I was a child, my older sibling would always gobble up all the Easter eggs before I even woke up in the morning. And so I better gobble that, that marshmallow now. And that would leave me thinking that in a behavioral finance context, where you talk, Tony, about these behaviors of disinvesting at really the wrong time, it makes me think that there is this internal narrative in relation to finance, that if we could start shifting that, Paul, for some of the people that are investing, I think we could start shifting some of those behaviors. And that's, of course, the domain I'm interested in, is how do we shift, how do we make people psychosocially healthier in every domain of their life, finance being one of those. And as you were sharing it, it started making me think of, you know, another fairly well-known experiment from a similar era to the marshmallow experiment is that old Ash conformity study, where, you know, they had these Confederates in the study, 7 of them, that would make a decision based on 3 lines. You know, they were presented 2 cards. Paul, I'm sure you and Tony are familiar with that. I'm just sharing it for those that aren't familiar. People were brought into a room, they were shown 2 cards. One card had 3 lines on it, A, B, and C. The other card had 1 line on it that was quite obviously the same length as the line B. And then the Confederates in the experiment, there were 7 of them that got to share which line, A, B, or C, they thought was the same as the other card. And when all 7 of them chose the incorrect answer, up to 75% of those that were being experimented on chose the incorrect answer because they just went with the crowd. Now, from a personality perspective, Paul, one might say that would be, you know, conscientiousness or lack of conscientiousness and high neuroticism, okay? From an emotional intelligence perspective, that would speak to a low self-perception. In other words, I have such a low view of my own view of the world that I must be wrong. There must be something wrong with me in this room. And so I'm just going to go with the crowd, a sense of insecurity. And that can be significantly shifted by certain techniques that shift self-esteem, shift self-perspective, shift internal narratives. Another way of coming at that same problem would be self-awareness in the domain of decision making. You know, Tony, you alluded just before you handed over the question to me, how do we get people to just pause and consider why they might be making a decision? And, you know, coming at it again from an emotional intelligence perspective, that layer of self-awareness, how do I manage myself, would start showing that there's something going on here, and the emotional data that I'm getting in this moment is one of confusion. You know, I'm clearly seeing something different to what these other confederates are doing. And instead of making a decision based on going with the crowd, if you like, which I think would be rooted in that kind of appease response, that appease reflexive response, I think someone would start being able to parse out the difference between I want to choose this and I should choose this, those decision domains of want versus should. And as techniques are implemented, Paul and Tony, to start shifting an awareness of causation of certain decisions that I make, I think what we certainly see in the domain of emotional intelligence is people start being equipped with resources to act on decisions that are far more prudent than the typical gobble up the marshmallow or just go with the crowd in the Ash conformity study. So I think it's very interesting, the perspective we're each bringing to this, Paul, because yours is a personality one, which is restrictive in terms of, you know, is change even possible? The perspective I'm bringing is one of competencies and emotional intelligence, where the variance on you know, improving these competencies is considerable. And I think that would leave us with the question, Tony, in the behavioral finance context, of how do we start actually shifting these behaviors, because it seems like that would lead towards a win-win for everyone. And that certainly is you know, something that's worth exploring. So I think that's what I would add, Tony.
Okay, guys, great. Thanks, Mark. I mean, I now want to add a layer of complexity to this, because in Paul's world, you're the investment house and you are the expert. And in most cases, now there's an advisor in this chain, and below the advisor or next to the advisor, depends on how you see it, is the client. And neither the advisor nor the client is an expert in this field. But as an investment house and as somebody now who heads up the behavioral finance side of this, how do you enable the advisors? How do we get to a place where the advisors can actually play a role in this, where they're equipped to do that, even though they are not experts in behavioral finance or emotional intelligence for that matter?
Yeah, Tony, look, I'll jump in first. I'm sure Mark's got some ideas as well. So firstly, absolutely, Mark, I sort of, I think you make a very, very good point as well. I mean, I think we're definitely coming at this from slightly different angles, but absolutely, I mean, even there's definitely in a number of papers as well, this you know, this realization as well that even though people have these factory settings, there's definitely, you know, through cognitive behavioral therapy and a number of techniques as well, you know, the ability to develop a competence as well. And incidentally, that's actually quite a cool, you know, it's too late for me now in respect of kids, but I mean, if you notice that your kids, for example, I mean, if I had kids and I'd sort of 10 years earlier with the knowledge I have, I mean, if you could sort of notice certain behaviors with your kids, like, for example, picking up and putting away stuff, right? You know, there's definitely the ability, it's not too late, you know, especially if you identify certain behaviors with your kids, that you actually build these competencies. And actually, if you do that from an early age, especially in financial competencies as well, by the way, that you could actually probably make that person's life a lot easier. Because, you know, these habits, when you form them at that point in your life, it'll become difficult to change. But if you form bad habits early on versus good habits, that obviously sets you up in a number of ways as well. But coming back to your question, Tony, I think advisors add a layer of complexity for sure, because it's another human being into the equation. I've certainly seen certain puzzling behaviors from advisors over a number of years as well. One is definitely in respect of this, you know, a behavioral science principle called, I just mentioned in the chat that they've got all kinds of Duplo or Lego on their lounge floor. That's not a, you know, there you go. There's the signal. Start now. But I mean, advisors sort of add a layer of complexity. And there's a principle in behavioral science called operational transparency, and that basically is, this idea that if you can sort of lift the hood and kind of show how things work, for example, it adds value, right? So in other words, there's a number of cool experiments they've done here actually on, creating perception of value in products where you take a long time to explain how complicated the thing is, and the more that detailed that explanation is, the more value is created, because the more complex the person who's actually buying the product sort of perceives. But the puzzling value that I've definitely seen from financial advisors is that, particularly in retirement planning, by the way, I mean, we've run a machine learning algorithm over people in living annuity products, for example, and the average number of funds, mutual funds or unit trusts that you find in a post-retirement person's portfolio is 12, right? So 12 funds is, I mean, in the South African market context, that's a lot, right? So that probably is over diversification or diversifying diversification, right? And there seems to be this kind of operational transparency here. So that's almost an effort that the advisor is saying, well, in a post-retirement context, I can't just pick one fund, right? Like an outcomes-based fund per, or whatever the case may be, because then how am I justifying fees? I have to pick more, so that there's this kind of operational transparency. There's more funds equals more work, therefore there's, that's how I earn commission kind of thing. So, there are some puzzling behaviors, I think, that already we're identifying that can definitely add value, and we can start to sort of pick away at that. But I also think in terms of, sort of things that behavioral science or behavioral finance sort of principles that can start to help advisors are definitely one in respect of a kit of introspection. So understanding a little bit more about the person who is advising the client. So we found in another study, by the way, that people's risk tolerance tends to bleed over into their client portfolio. So we actually did a study with Oxford Risk in 2021, actually just before the pandemic, and we published just after, showing that the advisor's risk preference tends to bleed into client portfolios. So in other words, an advisor has a certain way of viewing the world, and that view is passed on to their clients. But then in another way, obviously, there is this definitely understanding that needs to be developed between the advisor and who they are advising. So this person has, for example, a set of personality traits, money attitudes. They bring with them a history of interactions with money. Mark, as you mentioned as well, that's the context which is so important, right? So yes, I would be able to tell, or I would find value from a machine learning or kind of big data perspective to tell the advisor that this is the kind of factory settings that your client has. But definitely there's work to be done, where the advisor then can take that information and add value in terms of developing those competencies, right? Because there are techniques, for example, in financial psychology, where you could, so if you look at Brad and Ted Clance, I mean, they've got a number of, they work with the money scripts, for example, these money scripts inventories. They would have a lot of techniques that they would try and make a person more future orientated by assigning sort of a visual link to a goal, for example. You can think of examples like mood boards, or, if you want to save to buy a Porsche, put the Porsche on your screensaver on your computer, whatever the case may be, right? Basically what you're doing there is developing a visual link between what you want to do, so that when you open up your computer and you see that link, your behavior will change, or hopefully change, because of the fact that you're constantly being reminded of that goal that you're actually trying to achieve. So I think, Tony, coming to wrap up, I think there's definitely a number of things that are coming into play, right? And this is where things become quite complicated. The advisor is a human being who's at their own relationship and context in respect of their money journey. You then have a client who comes with their own, their own set of, circumstances or context. And then make it even more complicated, that person might be married to, or in a partnership with someone else who has their own set of values, beliefs around money as well. And then, of course, there's the mix in the relationship of who's dominant, who's earning more, there's a whole lot of stuff here. But I think that the really good thing, or the really encouraging thing about it, you can see how complex this becomes, is that there's plenty of value for that financial advisor to add. So I would say that in respect of where financial advice is moving, and we can talk about artificial intelligence and technology now, and I think that's where you're sort of getting to as well, Tony. Artificial intelligence, ChatGPT understands all of the stuff that I've just talked about now, right? So ChatGPT understands Big Five, understands present, future orientation, understands all of this stuff. So if you have these certain sort of triggers and sort of factory settings and more data, there is definitely an ability for an artificial intelligence to start presenting the information to the financial advisor and clients in a way that certainly resonates, for example, right? And of course, that artificial intelligence will not be able to replace the advisor, but I definitely think, much the way in football, there's the VAR or virtual assistant referee. I think it definitely has a role to play in respect of helping the advisor with their own behavior, and then also helping the advisor with the client behavior as well.
Yeah, absolutely. And thanks, Paul. Mark, before I prompt you guys on strategies, practicalities, etc., Paul has now set out quite a few things where emotion comes into play, and obviously emotional intelligence needed to guide the client, etc. But just on that, I mean, from an advisor perspective, you have to tailor your communications, because you sort of almost like trying to steer the client into a direction. You're almost trying to, you're challenging the client on things that he should be doing or things that he shouldn't be doing, that he is maybe busy doing, etc. Which is, most of us don't like being challenged on our emotions and on our behavior. And now this financial advisor actually has to start doing that. How shall I put it, emotionally intelligent communication look like? How do they, because they're not experts, they haven't got the knowledge. How do they get there?
Well, thanks for the question, Tony. Paul, as you were sharing, I was just trying to think. There is so much empirical evidence that's showing the things that you're talking about. I mean, it's almost indisputable. I can hear you almost wanting to shout about. You were talking about your PhD research earlier. It just baffles your brain that this is not front and center of the conversation for people in this domain. And as you were sharing about all of that, I was like, okay, Paul's got it on the science side. What is the very simple human answer to this? And a word came up for me, and I think it might be profound for me to just apply my mind to, but I think the answer for both parties in the relationship, for the client and the financial advisor, is empathy. Without all of the research that Paul has, we don't want all the financial advisors to become Paul Nixon, right? But there is so much research that is showing that if there is just empathy, it can allow that financial advisor to journey more appropriately and create more trust with that particular client in a way that seems to at times override some of these behavioral realities, because they will put their trust in the hands of that financial advisor. And so empathy, by the way, is a competency of emotional intelligence. This is something literally that the financial advisors listening in now can go and start actually developing. It is a muscle that you could develop. And what it means is that regardless of any of the background knowledge of what is the neuroscience of conscientiousness and neuroticism, is it on the big five? What is this person's fight, fright, freeze, please response? What was that research that Mark and Paul were talking about? There is just a connection and a resonance with that client that, with all the financial knowledge that you bring of the different products you have, there can be an intimate journey with them. And now that sounds very, very simple, but I want to perhaps just speak to something here that that we haven't touched on Tony and Paul, which is, how do we actually get into that kind of relationship with a client? And I think here something, Tony, that we have to look at and acknowledge is that there are two agents in the dynamic of making these financial decisions. There is the client, but there is also the financial advisor. And the degree to which they can, in fact, empathetically build relationship and a trust dynamic with this client is going to have a significant impact on the kind of decisions that they would make financially. And I want to just highlight something here, Tony, if you don't mind, and that is maybe just the state of some of the financial advisors and the uphill struggle that they are finding themselves in being able to build this kind of relationship with clients amidst the struggle to actually just hit targets, Paul, and sell product and get finance through the door, you know, because they carry their own, you guys listening in, carry your own fight, flight, freeze, appease, response. You carry your own personality constructs in relation to what Paul's been talking about. And just as a little bit of a wake-up call here, I want to just highlight, this is some research from just last year, so a little bit outdated now, but I think it still resonates. This is a huge sample size. This is from Sapien Labs. Many of you might be familiar with the research that they do. 419 responses. This is down from 550, by the way, Paul, you'll be interested in that. They cut any, because it was internet-enabled responses, they cut out from the sample any responses that flagged as people that were clicking too quickly on the responses. They had a certain time limit that it would take. They really wanted to just try and get valid and reliable responses. This is culturally appropriate across 71 countries and 13 languages. What Sapien Labs is measuring each year is something called the mental health quotient, which measures 5 domains. Now, imagine this as a financial advisor, that you, as an advisor that needs to walk a journey with a client and help them to make decisions, it is measuring your mood and outlook, your drive and motivation to keep picking up the phone, to reach out again when you've been ghosted by a client, cognition, ability to think well, your social self, the way you would interact with that client. Are you a little bit aggressive in trying to push them to buy products and so they actually just back off? And then your mind-body connection. And what they found is that globally, in terms of the mental health quotient score, 27% was sitting at what they measured as distressed or struggling. So that's you and me on this call. In South Africa and in the UK, by the way, they found these 2 countries to be ranked lowest in the mental state of the world. And in South Africa, it was 35% of obviously the sample on this particular assessment. But if we extrapolate this out to financial advisors and to your clients, you are sitting with 35% of us that are distressed or struggling. And what I wanted to highlight here for the financial advisors is that what they found is that the average days of being unproductive for you in your job, for those that are sitting in the distressed and struggling, it's over half of the time is left being unproductive. And what that means is that when you eventually get on the phone with a client, when you eventually get to have a meeting with them, when you eventually get through to them through the clutter of all of their inboxes and you're actually able to have a conversation, it is quite likely that empathy levels are low, that the ability to sit and be present with the client and actually their needs, like Paul was saying, with all of the dynamic that they bring. Who is the bigger earner in their household? What are the power dynamics in their marriage? And now they need to make a financial decision based on a marshmallow that they're going to gobble up or wait for, Paul. I think we need to have a look at ourselves as financial advisors and say, we're also struggling. They're also struggling. And so what can we do that when we are engaged with those people, those humans that we're engaged with, what can we do to be present in a way that Paul would allow them to trust us more than what they would get on ChatGPT? You know, because clients are going to ChatGPT now and they're typing in all those things that Paul's just mentioned, and they're making decisions before they even get into the call with you. And so I would put it to the audience, Tony, or maybe just to add to the conversation, that I think empathy is going to become more and more of a powerhouse for financial advisors, alongside some of the information that is now so readily available to them, and around some of what Paul has been sharing about, which are these behavioral realities. Empathy is going to become this guiding light for financial advisors. Can they carry empathy? Can they build that muscle for themselves Tony, through things like, I mean, we're working hard to try and do this. How do we build empathy in financial advisors? Well, through EQ development tech is the way we're applying ourselves to it. And I think, Paul, that you guys would do well over at Momentum to look at that. You know, how do we get these financial advisors to get into the engagement with clients in a way that they'll say, I'll trust Freddie more than I'll trust ChatGPT because of how he resonates with me in my life and the struggle I'm having to make these financial decisions. So, Tony, I think there's a lot of hope here that amidst all of the information that's becoming available to us in making financial decisions, amongst the fear that I'm sure financial advisors are carrying, Paul, with are they going to be replaced by AI? You know, I think there's going to be what's it being called at the moment online? The Milli Vanilli effect. I think they're calling it. I don't know if you remember that band, Tony, Milli Vanilli. They were complete fakes. Yeah. But there's some things starting to come out now online about the Milli Vanilli effect, which is that there'll be, 3 or 4 years maybe of people really trusting AI, and then they'll start saying, "Wow, I don't know what's true or false in terms of AI. I want to trust a human." And face-to-face is going to become the domain again, is what some of the futurists are predicting. They call it the Milli Vanilli effect, where people will realize, I don't know what's true or fake in terms of the online information I'm getting. And what I want is a human-to-human, eyeball-to-eyeball, heart-to-heart relationship that helps me to make the decisions in my life. And I think that future is a very optimistic one for financial advisors, and particularly those that can carry empathy and can garner the kind of relationships that will cause clients to choose based on the trust they have with that financial advisor.
Absolutely. I think maybe just sort of two things, Paul, in your experience as well. I think the one is that if I look at myself, I have a lot of financial planning experience. Used to be a CFP myself. I understand the short-term insurance industry very, very well. But I have both a financial planner and I have a short-term broker. The main reason why I have them is not because I think they've got better knowledge than me, but I want somebody else to take responsibility for certain things in my life that I know that's what they do, and therefore I allow them to take responsibility because I can rely on them now. And for lack of a better word, I can blame them if it doesn't work because I don't have to sit and put the effort in so that I don't have to blame myself when my claim doesn't get paid. And it's sort of almost like the advisors that, in my experience, have done the best are those ones that have that relationship with their client, where the client says, you know what, you make the decision. I'm not going to get involved in this. If you say I must put my money here and there and there, I'm fine with it. Just let me know, and if it doesn't go too well, then I'll say to you, listen, what have you done here? But I'm not going to interfere. How are you fixing this? So it's almost like that trust. Yes, maybe Mark, as you say, it probably comes through me seeing them as having empathy, understanding me, wanting to do what is good for me, and on the other side, having built that trust relationship. Paul, how do you experience that with successful advisors?
Yeah, Tony, so look, I mean, I definitely resonate with what Mark is saying and yourself as well. So I think, the problem with many financial advisors, I think, who work still on a transactional basis, and we can talk about why that is as well, and I think the system that they're operating in with targets and these kind of metrics that perhaps don't necessarily incentivize these deeper connections. I see a lot of financial advisors who have transformed their practices to the kind of stuff we're talking about now are generally successful ones. So they have the luxury of being able to do that, but many don't. So I mean, we can talk about the industry sort of view as well, but But I think just in terms of getting the behavioral change, I mean, what Mark is saying in terms of the empathy is just really the kind of key ingredient, right? So Jean Brunel, I think he's a CFA charge holder, and he does a lot of work in media as well. And I think he's in a family office in New York. I mean, he deals with New York listed, clients. So we're talking people, worth $100 million and above. And he talks a lot about the stuff. He talks about sort of turning, risk and return into dreams and nightmares. And I think it's a very important sort of statement, because people don't, human beings don't resonate with risk and return, right? That's a very mathematical, very, sort of financial construct. They resonate with dreams and nightmares. So, you can talk about retirement, for example, as a goal, but that doesn't really, that's a vacuous, nebulous kind of construct, right? People, first of all, I think it's Mark, you can keep me honest here, but I think more than 15 years into the future, you completely psychologically disconnect with that person. So that doesn't seem like you. When you think of yourself 15 years in advance, it doesn't almost seem like it's you anymore, right? Which means that your behavior is not really going to be connected to your future self, which is why we should never trust our future selves. But I think the important bit here is, retirement is a goal, but you need to turn it into a dream or a nightmare. So if you want behavioral change, you need to connect with what that client perceives as a nightmare, for example, right? Like becoming a burden on your children. So do you want to have to go to your kids and ask them for pocket money, or for a cell phone, or for, or to, whatever you may want, right? Of course, no one wants that. No one wants to be a burden on their kids. So the minute you connect that with that future self that is a kind of nightmare, that's where the emotional connection comes in, and that's where the behavior change will come in, right? Because people really don't want that, if that resonates with you, that means you're probably going to put a lot more money into your retirement because you want to avoid that. Similarly, if it's a dream, for example, you might want to spend time with your family in retirement. So, if your kids are traveling overseas, or they might even be overseas, you need to have enough money to make sure that you can either travel with them, or you can go and live with, or in the same city that they're in, right? That's a dream, for example. So those two things are very distinct from retirement as a just ticking retirement on a box and ticking $500 a month and kind of, here you go, there's your retirement annuity. It should be no surprise to you when that person cancels that product, kind of prematurely, because you haven't connected it. There's no emotional connection to that. And of course, you're also then falling into the kind of present bias, or that world where the person might be, well, I'll make it up. I'll stop paying it now, but I'll make it up later, right? So don't trust your future self. So definitely resonate with what you guys are saying. I think it's a very important piece of work that financial advisors need to do to kind of connect with their clients, and help their clients establish emotional connections as well. Because, by the way, a lot of people, and Morningstar showed this as well, people don't know this stuff, right? So, actually, when they showed clients a list of goals, their clients sort of picked them, and then they gave a slightly extended list, and the people's goals changed almost 100%, right? So people, in many cases, don't know what they want. You have to help establish those connections, and that takes work, right? It's not just about ticking boxes and all that kind of stuff. So from that point of view, definitely resonates. I think there's a tremendous amount of value that financial advisors can add. In a recent Harvard Business Review report as well, interestingly, it seems that people are using AI now for quite emotional things, right? So in the beginning, it was all about creating lists and creating ideas. Now it's going over to even things like finding purpose. People are looking to AI. We're kind of entering the loneliness generation, specifically when you look at the younger people, right? They're the loneliest generation. So people are looking to AI for things like finding purpose. Now, that should be concerning, because it means that they're not getting that from their financial advisors, but it definitely, on the flip side, it shows that there's a gap there as well, right? So there's a gap that humans can, or financial advisors, for example, can still offer to people, where they are actually looking in the wrong place for it, right? So they're looking to an AI for a very human, a very human sort of thing, right? Or like finding purpose, finding meaning, So financial advisors have I think a very, very strong role to play in the future. I think artificial intelligence is definitely has a massive role to play as well. But we need to be careful that we don't let the machines kind of because I don't think it's necessarily going to be one of those things where it's just automatic, right? People are just going to go to humans for human stuff. I mean, I think there's definitely a very real threat that if we don't, or financial advisors don't offer that value, believe you me, people will find it somewhere else. They're already finding it somewhere else, or looking for it somewhere else, which is not good. but it shows there's an opportunity as well.
Absolutely. Maybe just starting to wrap up a little bit, starting with you, Mark, maybe giving us a few practical strategies as to how to build emotional intelligence.
Yeah, thanks, Tony. I think, you know, one of the things I think is that free giveaway that you guys are going to do, which is, you know, the listeners can, you know, use the app Mygrow to develop their EQ. But just to be quite concrete about some of the exercises, you know, again, I feel myself needing to, thanks, Brent. Brent, by the way, has just put up a 30-day free trial for you guys on the chat pane here. But one of the things that many people find difficult about emotional intelligence is that some exercises are so easy to do that they're easy not to do. And what we have to bear in mind is that, you know, if you think of a push-up, a sit-up, or a pull-up, it really is a very simple movement. You know, you lie on the floor and you push yourself up. And yet, all of us, from the three of us on this call, you, Tony, Paul, and me, we need to do push-ups just as much as someone like Siya Kolisi or Usain Bolt needs to do push-ups if we want to strengthen those muscles. And so very easy to do, but there are layers and layers of maturing with the same technique. Eventually it would become a bench press and you put a whole lot of weights on it. It's a push-up, right? And so some of the techniques that are possible for those listening in, you know, we are predominantly wired to pick up threat in our lives. It's part of what, you know, a little part of our brain called the amygdala is doing. It's constantly scanning for threat. That's why we have this fight, flight, freeze, appease response, right? So we're neurologically wired for that. And what we can start doing is use certain techniques like the 3 good things technique. You write down a few good things, 3, if you like, is what some of the empirical validation of this technique was done on. And then you start unpacking why that good thing was possible. It's a very, very well-established positive psychology technique. You do that each day. And what it starts doing is it starts rewiring the neural circuitry in one's brain to start picking up some of the good in the world. Another technique called the ABCDE technique can help someone to manage negative emotions. So let's say you have a really difficult client call, or one of your client phones you and says, hey, I'm moving to a different financial advisor, or I'm shutting down this portfolio, whatever the right, you know, words are to use, Paul. And you need to make another call, but you're still reeling with some of that negative emotion. The ABCDE technique helps one to move through a set of stages. It's a little bit like creating a bit of a balance sheet for one's emotions and rationality. It's a famous technique. You can Google it, ABCDE technique, from a psychologist, Albert Ellis. It's from a domain of psychology called rational emotive behavioral therapy. So it's saying, how do I use some rationality to deal with the emotions I'm experiencing so that I can behave in an effective way? And essentially what it is starting to understand what are some of the triggers that are happening for me in relation to this, this particular activating event. And then there's some other techniques, Tony, you know, certain mindfulness techniques, different breathing practices that can help a person really with the kind of stress that they're under, to just be more cognitive in conversations with clients of the other. Well, practicing certain mindfulness practices, it's as easy as a sit-up, but over time, as we become more mindful, things like empathy, as I've described, will start allowing us to be more present with clients. And instead of getting more and more frustrated and aggressive in pushing products onto them, we'd be more receptive and able to track with what their actual needs are, and find products that will more appropriately service those dreams and avoid those nightmares, as Paul was saying. So that's just a sample of some of the techniques, Tony. But I'd suggest those listening in just jump onto Mygrow and use the tech to help them start developing those EQ competencies.
Thanks, Mark. And then Paul, just from your side, sort of, where do you start with financial advisors on this journey towards being a bit more involved with behavioral finance, understanding it a bit better, and applying some of the techniques that you guys use?
Yeah, thanks, Tony. I mean, I think I think financial advisors will hopefully, excuse me, start to be exposed to more things, and I think there's also I've seen this in a number of engagements I've had with financial advisors as well, that there might be a little bit of a fear that I think there's comfort in income statements and balance sheets, right? So it's very quantitative, which provides comfort. So it's very easy to analyze an income statement, balance sheet, work out a couple of ratios and say to a client, well, look, this is what you need to change in order to create saving, and this is how over time that's going to play out. But I think there's not enough emphasis on how the client got to those numbers in the first place, right? And I've used and spoken about a number of examples of this as well. So that's on the one side. The other side, I think there's a growing concern amongst financial advisors that they need to become psychologists, right? That's not the case at all as well. So your core competency is definitely still in the income statement and balance sheets and the kind of technicalities that surround that. But you can definitely make yourself a hell of a lot better, and you can also create a lot more behavioral change if you bring some of the other stuff to the table. And I think as financial advisors as well, with financial psychology now, or psychology being in the CFP syllabus, we still need to understand that there's a clear line between that financial advisors will never cross, right? So if someone, for example, has some kind of gambling addiction or compulsive spending, that's not your job as a financial advisor to change, right? Because that probably sits in the domain of financial therapy or someone who has a medical license or definitely a psychologist, right? But I think that once we start enabling it or giving advisors the tool sets to be able to, on a very, very simple level, maybe give an indication of where they should maybe scratch a little bit more, right? So, for example, if you can see someone has a high level of money anxiety or a high level of neuroticism or a low level of conscientiousness or whatever the case may be, there's probably going to be a story behind those. Definitely the money attitudes piece, right? So I've seen that in a number of cases as well. If you see someone has a high money anxiety, there's always a story behind that. So it might be a business. Their parents might have been sequestrated when they were young, or their parents might have run out of money. Or I was having a chat to a colleague whose husband died during COVID, for example, right? These all carry stories. So once you have that instrument and once you see those metrics, it gives you an idea of where to scratch. Now, not all clients are going to be ready to enter that journey with you as well. So, just like when if you go into marriage counseling, for example, and your partner's not into it or you're not into it, it's not going to work. Same applies to this scenario as well. If clients don't want to talk about, that's fine. That's absolutely cool. Maybe over time, as Mark said, when you develop that trusted relationship, clients become a little bit more willing to share those kind of stories, because once you develop those connections between the money anxiety and what's actually causing it, that opens the path for behavioral change, or to do the work, to do these exercises, right? So I think behavioral finance is the quantitative side of behavioral finance anyway is a good way of using things like personality theory and money attitudes and those kind of things, and what Mark is talking about as well. What Mark is talking about is the techniques to actually change that behavior, right? Or to start sort of tilting the odds more in the client's favor in terms of making better decisions. But I think that this is a good place to sort of be in between. So the menu is wide for the financial advisor. I think that's important, but it doesn't mean we're not moving to a place now where financial advisors have to be psychologists. In actual fact, I mean, I had an interesting story the other day. A financial advisor came to me after a session and said that she's actually too good at the coaching piece, and now she's not earning as much money. Right now, that's a serious problem. So you have a financial advisor who's really good at the coaching side of things, but it means she's not selling as many products as she used to, which means that she's actually earning less. Right now, I mean, that's a whole nother sort of discussion that we should probably have at some point in time. But I think in a nutshell, I think there's once financial advisors start to diagnose, we give them tools to diagnose these elements from, at a very, very high level even. It starts giving or enabling different conversations. And this even happens subconsciously as well. So if you want to, set up or hyper-personalized communication to clients as well, with the understanding of some of these dimensions that we've talked about during today's webinar, there's certainly it gives you a good indication of which segments or which pockets of clients probably need more or less help at different points in markets as well. And I think that it really takes takes the proposition of the financial advisor forward to hyper-personalize their communication, for example, the way they engage with their clients, the sort of different products that they offer as well. I think we're going into a very interesting time in respect of incorporating a lot of these things practically, right to the other end of the spectrum as well, where where you want to spend more time on the behavioral change element as well. I think there definitely needs to be some sort of commercial model, though, in respect of recognizing that competence as a financial advisor and actually paying the client for that separately to sort of a product sale.
Yeah, absolutely. So it almost sounds like financial advisors should at least start with working on their own emotional intelligence, because it will give them an understanding of the concepts. It will give them an understanding of their own behavior that they could potentially see in their clients. And in that sense, I saw there was a bit of a chat on the chat here about the empathy that you mentioned, Mark, and the discussion there is how possible is it to develop empathy?
Am I on mute? No, sorry. I was going to click mute. Yeah, Tony, I mean, that's the beauty of this domain of emotional intelligence, is that it really is about neural pathways. So as one practices certain techniques that promote empathy, it starts allowing one to not only interpret empathetic cues from others, but actually to sense and experience the emotional side of empathy, the sensation of empathy, if you like, which then is going to create a huge variance in the behavioral response that one has in any given moment. And so the short answer is that it's as developable as a muscle. And it really just requires the implementation of those techniques over time. I see Michael signed up to that 30-day free trial, and I would love to hear your thoughts on it, Michael, as you've gone on that journey for a little bit. But this is what is astounding about the domain of emotional intelligence, Tony, is just there is a significant degree of shift in these competencies that is possible based on the technique implementation over time. So yeah, I think for the financial advisors, both in terms of building and developing empathy for their clients, I think that is there's huge potential there for them to grow their themselves and their practices. And then in terms of them just navigating some of the current moment of the struggle that they may be having, if some of that Sapiens Labs mental health quotient resonates with anyone on the call, I think those two domains become very powerful and compelling reasons for developing their own emotional intelligence.
Yeah, absolutely. Guys, we've come to the end of this discussion. Really, really great. I wanted to just give you an opportunity, Paul, firstly, to just any closing remarks on this this discussion.
Thanks, Tony. Yeah, no, I think we've gotten through a lot today. So yeah, I think it's yeah, I'm looking forward to working with financial advisors in Momentum, at Momentum, as we start to explore these different dimensions and diagnosis tools, and giving financial advisors a lot more insights about their clients as well, to hopefully get behavioral change, right? And actually doing the next thing, during the next version or iteration of two-part, hopefully, preemptively this time we can, engage with the right people at the right time with the right message to help change that behavior.
Yeah.
But thanks very much for having me, and Mark, it was a great to chat with you on the call as well. So really good perspective.
Thank you, Paul. Mark, closing remarks, yeah.
Yeah, just an encouragement, I think, that, flourishing starts at home. If you want to flourish in your financial advisory business, Paul mentioned a few financial advisors that have ended up being quite successful. it seems to be quite deeply linked to the relationship with yourself. Can you manage yourself effectively and get out there and sell what you need to sell? And can you manage your interactions with others effectively, which I think is an angle I've brought quite strongly, that empathy. And so, part of what Tony and Cover has made available is a 30-day free trial to Mygrow, where you can go and start developing your EQ through this app. So just an encouragement to go and do that. It's one more set of tools to add to your arsenal. And ultimately, certainly what we're seeing is that it's helping people to flourish in their practices and their building of relationships with clients. So thanks, Tony.
Oh, thank you, guys. I think it was a really good discussion. Long overdue for us to discuss this in more depth. And yeah, Paul, thanks for carrying that flag in the financial services space, and looking forward to see things develop further. So thank you, everybody, for joining us. As Brent put into the chat there, we will share this on YouTube for everybody, and then take advantage of that free trial and see how it works. I certainly will. So thank you very much, everyone. Great to see you guys, and thanks for joining us.